Well, I'm sitting here in my office in Omaha, and I just read something that most Americans are completely missing. Something that's going to reshape the global economy in ways we haven't seen since the end of World War II. China has officially become the fourth nation to achieve manufacturing superpower status, joining the United States, Germany, and Japan. And let me tell you, this isn't just some headline. This is the most significant economic shift of our lifetime. Now, I've been investing for over 75 years, and I've seen a lot of changes. I've seen the rise of Japan in the 1980s. I've seen Germany rebuild after the war. I've seen America dominate manufacturing for decades. But what's happening with China right now? It's different. It's bigger. It's faster. And most importantly, it's creating an investment opportunity that comes along maybe once or twice in a century. See, when I read that report, the 2025 China Manufacturing Superpower Development Index, I wasn't surprised. I've been watching this for years. But what did surprise me was how few investors understand what this actually means for their money, for their portfolios, for their financial future. So that's what I want to talk about today. I want to tell you about the one investment that I believe will not just double or triple by 2030, but could genuinely increase tenfold. 10 times your money in just 5 years. And it all comes down to understanding what happens when a nation of one, for a billion people, becomes a manufacturing superpower. Let me start by explaining what manufacturing superpower actually means, because most people don't really understand this. It's not just about making a lot of stuff. It's not just about cheap labor or big factories. A manufacturing superpower means you have the complete ecosystem. You have the technology, the infrastructure, the supply chains, the innovation, the quality control, the logistics, everything working together at the highest level. There are only 4 nations in human history that have achieved this status. The United States did it first, really ramped up during World War II, and dominated for decades. Then Germany rebuilt and became a manufacturing powerhouse, especially in automobiles, machinery, precision engineering. Japan achieved it in the 1970s and 80s with electronics, automobiles, robotics. And now China has joined this exclusive club. Think about that for a moment. Out of nearly 200 countries on Earth, only 4 have ever reached this level. This is extraordinary. And here's what most people don't realize. When a country becomes a manufacturing superpower, it doesn't just make things cheaper. It fundamentally changes the global supply chain. That IT shifts economic power. It creates wealth on a massive scale. And most importantly for us as investors, it creates enormous opportunities to make money if you know where to look. Now, let me tell you what I've been watching. Over the past decade, China hasn't just been making toys and cheap electronics anymore. They've moved up the value chain dramatically. They're now producing advanced semiconductors, electric vehicles, renewable energy equipment, high-speed rail, 5th-generation telecommunications equipment, aerospace components, advanced pharmaceuticals. This isn't low-tech manufacturing. This is cutting-edge technology production at massive scale. I was looking at some numbers recently. China now produces more electric vehicles than the rest of the world combined. They manufacture over 60% of the world's solar panels. They control the supply chain for batteries that power everything from phones to cars to grid storage. They've built more high-speed rail in 15 years than Europe built in 50. And here's the kicker. They're doing all of this while simultaneously being the world's largest consumer market. That combination, manufacturing power plus consumer demand, that's unprecedented in modern history. See, when Japan became a manufacturing superpower, they had about 120 million people. Germany had about 80 million. The United States, even at its peak dominance, had maybe 150 million during the post-war boom. But China has 1 for a billion people. The scale is completely different. The implications are completely different. And the investment opportunities are completely different. Now, I know what some of you are thinking. Warren, isn't this bad for America? Doesn't this mean we're losing? And let me be clear about something. I'm an American. I love this country. I made my fortune here. But as an investor, my job isn't to be patriotic with my money. My job is to see reality clearly and invest accordingly. And the reality is this: China becoming a manufacturing superpower doesn't mean America loses. It means the global economy is changing and smart investors need to adapt. Think about it this way. When Germany became a manufacturing powerhouse after World War II, did that hurt American investors? No. Smart American investors made fortunes investing in German companies, in the supply chains that fed German manufacturing, in the commodities that German factories needed. The same thing happened with Japan. American investors who understood what was happening made enormous amounts of money investing in and around the Japanese manufacturing boom. And that's exactly what's happening now with China. This isn't about politics. This isn't about nationalism. This is about recognizing an economic megatrend and positioning yourself to profit from it. And that brings me to the one investment I believe will increase tenfold by 2030. Now, before I tell you what it is, let me explain my thinking, because this isn't just a guess. This is based on 75 years of studying how these transformations work, how wealth gets created when economic power shifts. See, when a country becomes a manufacturing superpower, there's always one sector that benefits more than any other. One type of asset that captures the value being created. And that asset is supply chain infrastructure. Let me explain what I mean. Manufacturing doesn't happen in isolation. You need raw materials. You need energy. You need logistics. You need ports, railroads, ships, warehouses, distribution networks. You need the entire supply chain working seamlessly. And as China has become a manufacturing superpower, they've built the most sophisticated supply chain infrastructure in human history. But here's the key: they can't do it alone. They need resources from all over the world. China doesn't have enough oil. They import about 75% of their petroleum. They don't have enough copper, iron, or lithium, cobalt, rare earth elements. Well, actually they have rare earths, but they need many other critical materials from other countries. They need food, agricultural products to feed 1 billion people. And as their manufacturing capacity grows, as they move up the value chain, as they produce more advanced products, they need more and more of these basic commodities. And that's where the opportunity is. The one investment I believe will increase tenfold by 2030 is commodity-producing infrastructure in countries that supply China's manufacturing machine. Specifically, I'm talking about companies that own ports, railways, mining operations, energy infrastructure, agricultural logistics in countries like Brazil, Australia, Indonesia, Chile, South Africa, Canada. These are the countries that have the raw materials China needs, and the infrastructure companies that move those materials are going to see explosive growth. Let me break down why this is such a powerful investment thesis. First, demand is essentially guaranteed. China can't stop manufacturing. Their entire economic model, their employment, their social stability, it all depends on keeping the factories running. And to keep the factories running, they need raw materials. Constantly, in massive quantities. This isn't speculative demand. This is structural, long-term, locked-in demand. Second, supply is constrained. You can't just build a new copper mine overnight. It takes 10 to 15 years to bring a major mining project online. You can't build a new deep water port quickly. You can't build new rail networks to move commodities in a year or two. This infrastructure takes time, capital, expertise. And most importantly, there aren't that many companies that own these critical assets. Third, pricing power. When you own the infrastructure that moves critical materials that a manufacturing superpower needs, you have pricing power. You can charge premium rates because there are no alternatives. If China needs iron ore from Brazil, it has to move through specific ports on specific rail lines owned by specific companies. Those companies can raise prices, increase margins, and nobody can do anything about it. Fourth, and this is crucial, inflation protection. One of the biggest risks investors face right now is inflation. Central banks have printed enormous amounts of money over the past few years. And when you print money, commodity prices eventually go up. But here's the beautiful thing about owning commodity infrastructure. When commodity prices rise, the companies that move those commodities make more money. Much more money. It's built-in inflation protection. Now let me give you some specific examples of what I'm talking about. There's a company in Brazil that owns the rail lines that move iron ore from mines to ports. China imports about 1 billion tons of iron ore per year, and a huge percentage of that comes from Brazil. This company has a monopoly on those rail lines. When iron ore prices go up, they make more money. When China needs more iron ore, they make more money. There's no way around it. That's the kind of asset I'm talking about. Or look at Australia. They've got these massive port facilities that export liquefied natural gas, coal, iron ore, all the things China's factories need. The companies that own those ports, they're essentially toll collectors on the supply chain that feed Chinese manufacturing. And those tolls keep going up because demand keeps going up and there's no alternative route. Or consider the mining companies themselves, the ones that actually extract the copper, the lithium, the cobalt that goes into electric vehicles and batteries and electronics. These aren't speculative exploration companies. I'm talking about established producers with proven reserves, with existing operations, with long-term contracts with Chinese manufacturers. As China's manufacturing capacity grows, these companies will sell more product at higher prices. It's that simple. Now, I want to address something important here. Some people are going to say, Warren, what about geopolitics? What about tensions between the United States and China? What about trade wars and tariffs and all of that? And my answer is this. Look at the actual data, not the headlines. Despite all the political noise, despite all the rhetoric, trade between China and the rest of the world has continued to grow. Why? Because economic reality trumps political posturing. China needs the resources. Resource-rich countries need China's money. That dynamic isn't going away. In fact, I'd argue that geopolitical tensions make this investment thesis even stronger. Here's why. As tensions between major powers increase, China becomes even more focused on securing reliable supply chains. They're willing to pay premium prices for guaranteed access to critical materials. They're investing in long-term relationships with supplier countries. They're building redundancy into their supply chains. All of that means more revenue, more profit for the infrastructure companies that connect China to these resources. Let me tell you about the math on this, because I'm not just throwing around the 10x number casually. This is based on realistic projections. Right now, many of these commodity infrastructure companies are trading at reasonable valuations. Not cheap, but not expensive either. They're generating solid cash flows, paying dividends, growing steadily. But the market hasn't fully priced in what happens when China's manufacturing capacity continues to expand over the next 5 years. China has stated goals to become completely self-sufficient in advanced manufacturing by 2030. That means massive investments in domestic production of semiconductors, aircraft, pharmaceuticals, everything. And every step toward that goal requires more raw materials, more energy, more agricultural products. The demand curve for commodities is going to be incredibly steep over the next 5 years. And the companies that own the infrastructure to move those commodities are going to see their revenues and profits grow exponentially. Let me give you a conservative scenario. If these infrastructure companies grow their revenues by 15% per year for the next 5 years, which I believe is very achievable given the demand dynamics, and if their profit margins expand even slightly due to pricing power, and if the market decides to value them at slightly higher multiples because investors recognize the strategic importance of these assets, you're looking at stock prices that could easily be 7 to 10 times higher than they are today. That's not speculation. That's basic financial math applied to a structural megatrend. Now, I want to be clear about the risks because there are always risks. Nothing is guaranteed in investing. The biggest risk here is probably a severe global recession that causes Chinese manufacturing to contract significantly. But even then, China is not going to stop manufacturing completely. They might slow down, but the long-term trend is still upward. Another risk is that China develops alternatives. Maybe they find new suppliers. Maybe they figure out ways to recycle more materials. Maybe they become more efficient. But again, the timelines on all of that are measured in decades, not years. For the next 5 years at least, they need the existing supply chains. The other risk people worry about is political risk in the countries where these infrastructure assets are located. What if Brazil or Australia or Indonesia nationalizes these assets? What if there's political instability? Well, that's a real risk, but it's manageable. You diversify. You don't put all your money in one country or one company. You spread it across multiple geographies, multiple commodities, multiple infrastructure types. That way, even if one asset gets nationalized or one country has problems, your overall portfolio still performs well. Let me talk about diversification for a moment, because that's crucial to making this strategy work. You don't want to just buy one mining company or one port operator and hope for the best. You want to build a portfolio of these commodity infrastructure assets spread across different countries, different commodities, different types of infrastructure. Maybe 20% in Brazilian logistics, 20% in Australian mining, 20% in Indonesian energy infrastructure, 20% in Canadian agriculture, 20% in Chilean copper. That kind of diversification gives you exposure to the entire megatrend while protecting you from country-specific or commodity-specific risks. And here's something else I want you to understand. This isn't a trade. This isn't something where you buy and sell based on quarterly earnings or short-term news. This is a long-term strategic investment in a megatrend that's going to play out over years, possibly decades. When I invest in something like this, I'm thinking about holding it for 5 years minimum, probably longer, because the real wealth creation happens over time as the trend builds momentum, as the demand keeps growing, as these companies compound their cash flows year after year. You know, I've always said that my favorite holding period is forever. And while I might not hold these particular investments forever, I'm certainly thinking in multi-year time horizons, because that's how you capture the full value of a structural shift like this. If you try to trade in and out, if you try to time it, you'll probably miss the best gains. But if you buy quality assets at reasonable prices connected to an unstoppable megatrend, and you just hold on, you let time and compounding do their work, that's when you make serious money. Let me tell you something else. This opportunity exists right now because most investors are looking in the wrong places. Everyone's obsessed with technology stocks, artificial intelligence, cryptocurrency, all the shiny new things. And don't get me wrong, some of those investments would do well, but they're also incredibly crowded. Everyone sees those opportunities. The valuations are sky high. The competition is intense. But these commodity infrastructure plays, most investors aren't even thinking about them They're boring. They're in unsexy industries. They're in emerging markets that American investors don't pay much attention to. And that creates opportunity for those of us who are willing to look beyond the obvious. This reminds me of the early 2000s when everyone was obsessed with internet stocks. And meanwhile, I was buying boring old companies like railroads and utilities. People thought I was crazy. They said I didn't understand the new economy. But you know what? Those boring infrastructure investments made me billions while the dot-com bubble burst and destroyed a lot of wealth. This feels similar. Everyone's chasing the hot new thing. And meanwhile, there's this massive structural opportunity hiding in plain sight. Now, I want to address something about China specifically because I know some people are uncomfortable investing in anything related to China, and I get it. There are concerns about transparency, about government control, about intellectual property, about human rights, all legitimate concerns. But here's the thing. I'm not suggesting you invest directly in Chinese companies. I'm suggesting you invest in the companies that supply China, companies headquartered in Brazil, Australia, Canada, Chile. These are companies with strong rule of law, transparent financial reporting, alignment with Western interests. You're not taking on Chinese political risk. You're taking on Chinese demand risk, which is very different and much more manageable. In fact, you could argue that investing in China suppliers is actually less risky than investing in Chinese companies directly, because you get the upside of China's growth without the downside of Chinese governance. You're getting paid by Chinese demand without being subject to Chinese regulations. That's actually a pretty elegant way to play this megatrend. Let me also talk about the timeline here because I mentioned 2030 and that might seem far away. But in investing, 5 years is actually not that long. And the beautiful thing about this investment thesis is that you don't have to wait until 2030 to see returns. This is going to play out gradually over the next 5 years. You'll see quarterly earnings grow. You'll see dividends increase. You'll see stock prices rise steadily as more investors recognize what's happening. By 2027 or 2028, this thesis will probably be obvious to everyone, and that's when the really explosive gains happen as capital floods into these stocks. But right now, in early 2025, you can still get in at reasonable prices before the crowd arrives. And that's the key to making money in investing. You have to see things before they become obvious. You have to recognize trends before they're front page news. Because once something becomes obvious, once everyone agrees it's a good investment, the easy money has already been made. Right now, China being a manufacturing superpower, that's becoming obvious. But the implications for commodity infrastructure, for supply chain investments, that's not obvious yet. Most investors haven't connected those dots. And that's your window of opportunity. You know, I've been doing this for a long time, and I've learned that the best investments are often the ones that seem boring, that nobody's talking about, that don't make exciting headlines. The investments that make you feel smart at cocktail parties, those usually don't make you rich. But the investments that make people's eyes glaze over when you mention them, those are often the ones that compound wealth over time. And commodity infrastructure definitely falls into that category. Nobody's excited about Brazilian rail companies or Australian port operators, but they're going to make a lot of people a lot of money over the next 5 years. Let me paint you a picture of what I think is going to happen. Over the next year or two, investors are slowly going to wake up to this opportunity. You'll start seeing more articles about commodity supply chains, more analyst reports on infrastructure companies, more institutional investors building positions. Stock prices will start rising maybe 20, 30, 40% in the first couple of years. That'll get more attention, bring in more investors, push prices higher. By 2027 or 2028, this will be a well-known investment theme. CNBC will be doing segments on it. financial advisors will be recommending it to clients. And that's when you'll see the really big moves, maybe doubling or tripling in a single year as momentum builds. By 2030, these stocks could easily be worth 10 times what they are today, maybe more if commodity prices really take off. But here's the thing. To capture that full 10x return, you need to buy now, or at least soon, while prices are still reasonable. If you wait until this becomes obvious, until everyone's talking about it, you might still make money, but you won't make 10x. You'll make 2x or 3x, which is still good, but not transformational. The transformational wealth is created by the investors who see it early and have the patience to hold through the entire cycle. Let me tell you exactly what I would do if I were building this position today. First, I'd allocate a significant portion of my portfolio to this theme, maybe 25 to 35%. That's a big bet, but this is a big opportunity. Second, I diversify across at least 10 to 15 different companies in different countries and different parts of the supply chain. Some mining, some logistics, some energy, some agriculture, spread across multiple geographies. Third, I buy quality. Not the cheapest companies, not the most speculative ones, but the established leaders with proven assets, strong balance sheets, experience management. Pay a fair price for quality. Fourth, I'd set up a plan to hold for at least 5 years, probably longer. No trading, no trying to time it, just buy and hold and let the trend play out. And fifth, I'd reinvest the dividends. Many of these infrastructure companies pay solid dividends, 3, 4, 5% or more, that if you reinvest those dividends, you're buying more shares, accelerating the compounding. Over 5 years, that can add significantly to your total return. You might turn 10x into 12x or 13x just by reinvesting the dividends along the way. Now, I know some of you are thinking this sounds too good to be true. 10x in 5 years. That's a huge return. What am I missing? And that's a fair question. You should always be skeptical when someone promises huge returns. But let me tell you why I believe this is realistic. This isn't based on speculation or hope. This is based on fundamental demand that's essentially locked in. China needs these materials to keep their economy running. They have no choice. And the companies that control the infrastructure to supply those materials are in an incredibly strong position. It's not that complicated. It's supply and demand at the most basic level, but on a massive global scale. I'll leave you with this thought. In my entire career, I've seen maybe 4 or 5 opportunities of this magnitude. The post-war boom in America, the rise of Japanese manufacturing, the growth of German industry, the emergence of global technology companies, and now, China becoming a manufacturing superpower. Each of these created enormous wealth for investors who recognized what was happening and positioned themselves accordingly. This is one of those moments. This is one of those rare opportunities where you can look at the big picture, see a clear trend, identify the investments that will benefit, and make a strategic bet that could transform your financial future. China becoming the 4th manufacturing superpower isn't just a headline. It's the beginning of a new economic era. And the one investment that will capture the value being created is commodity supply chain infrastructure. That's my conviction. That's where I'd put my money if I were building a portfolio today for the next 5 years. The companies that own the rails, the ports, the mines, the pipelines that feed China's manufacturing machine, those are going to see explosive growth. And investors who position themselves now, who have the patience to hold through the inevitable volatility, who stay focused on a long-term trend, they're going to be very, very wealthy by 2030.